Hello, everyone. Hello, our leads, our students, and our audience. Today is a very special day here in FK Partners because, as you all know, we've been doing executive training for the most important certifications in the world for almost 20 years. And it's not every day that we get to receive a very important person, a very distinguished person in this environment. Today, I will be talking to Bill Kelly. He's the CEO and the president of the CAIA Association. CAIA Association here for us is one of the three main international certifications we have in Brazil. CFA, CAIA, FRM are probably the most important for Brazilian professionals. And it's a pleasure to have him here with us. So before any further questions, Bill, thanks a lot for being here with us and for your time.
No, a pleasure's mine, and it's an honor to be on this platform, Raphael. And it was great meeting you just a few short weeks ago down in Sao Paulo. Very much enjoyed that visit.
Yeah. For those who don't know, Bill was here a couple of weeks ago. We have this very nice event for CAIA charter holders. And Bill didn't want to go back to the US. He loved Brazil so much that he wanted to stay forever. But now he's back there home. And Bill, I just want to start asking you, what is your trajectory until getting here? Because no one is born and becomes a CAIA Association president. So in a nutshell, what's your story to getting here?
Yeah, and I think it's there's a story to everything, and I think tucked in there may be some advice too that life gets in the way of planning. And I'd like to say it was a grand plan 40 some odd years ago after I got out of college that I'd be sitting in this role, but quite to the contrary, I've had a couple of very interesting pivots in the course of my career, all very good ones. But I started out, and as we talked about behind me, I've got my CPA below and my CAIA chart above. I started out as a public accountant with Price Waterhouse out of college in 1982. And didn't love being a public accountant, but loved learning how businesses work, how to read a balance sheet. And I think that set me down a path of curiosity around financial services, where I spent the vast majority of my career. And I left as CEO of the subsidiary of Robeco, the U.S. asset management subsidiary, which we had sold to them in 2002, left at beginning of 2009. But then I had some restrictive covenants, did some board work. And one of the boards I was on was selling liquid alts to the masses. And This is before I really knew much about CAIA. And I was thinking, wow, this is kind of an interesting value proposition, but does the end investor know what they're getting? And I think the rest of it was probably destiny and happenstance. I learned a little bit more about CAIA. They happened to be doing a search for a CEO. And this is just about a decade ago. So I'm coming up at 10 years at CAIA. And I would say, without qualification, the very best job I've ever had. I just love the mission. I love the outreach. I love meeting members like you and partners around the world. And I think we have a tremendous responsibility to help the end investor to understand how to get themselves to better outcomes.
Yeah, it's interesting when you say that people are not really fully informed of all the things they need to invest in an alternative investment. I suppose the US is better than Brazil in this sense. But in here, you basically have fixed income and equities, and everything else is just a side bucket that no one really cares too much about. But do you see that market growing in terms of knowledge and information and advertising and public education to everyone?
The short answer is yes. And longer answer is if you look at 2022 is a very interesting year, because one of those rare years where both long-only public equities had a very high level correlation to public fixed income. So the diversification benefit that an investor got at a 60-40 went away, and the index drew down quite substantially, and diversification play did not help at all. I think that's going to turn out to be a bit of an aberration. Things happen in markets when you don't expect them, especially in the short term. But long term, I think there's still viability of the 60-40. But maybe lesson learned is that there's been an evolution, not a revolution, about where lending is taking place. And coming out of the global financial crisis, certainly in the US and maybe around the world, banks are lending less. And the private debt, private credit market didn't really exist in 2008. And now it has well over $1 trillion, maybe on its way to $2 trillion. So we've seen a movement of lending from the public banks into the private lenders. So if you think about access to that 40% of your portfolio, it's still going to be thought about as fixed income, but there's much different ways of accessing it. Same is true for equity. Rather than think about this weird third bucket, think about the 60% in equity, and then think about capital formation and value creation more and more happening in the private markets. And why shouldn't I be able to access that? Why shouldn't I be able to maybe dampen down some of the volatility to drawdown risk by using hedge funds? Yeah. Are there structured products or options I can use to maybe adjust the equity exposure I'm looking for? So I think rather than try to talk about alternatives as this third thing that most people don't understand, why not talk about it in corridors they already do understand around the 60-40? And I think that's a much better pathway toward understanding and hopefully success to the end investor.
Same goes for products that protect against inflation, which is kind of a worldwide concern at this moment. So you have commodities, you have real estate, and all the structures underneath that are a consequence of this concern for inflation, right?
Oh, absolutely. Very much on the hearts and minds of most people around the world. The U.S., we were talking about it being transitory until it wasn't. And to think that inflation is going to sustain back down at the 2% level, I simply don't see it. So I think inflation in the 4 to 5% range is real. And I think we've got to get ourselves and our heads wrapped around that. And the thought about diversification around commodity plays is an example to get some kind of exposure to an asset class that will perhaps perform better during high inflationary periods.
Yeah. Let me get some more into your story, because it's very interesting, and you're obviously here well longer than me, so you've probably seen a lot of things and ups and downs and all this turmoils and recoveries, etc. You are an executive of the CAIA Association foremost. You're not really an alternative investor technician, right? How did you get the curiosity to get the CAIA charter? How did you pursue the CAIA charter?
Well, I was a very, very late bloomer there on the one hand, but on the other hand, as I mentioned, with my CPA in the very beginnings of my career, I believed in credentialing. And when I first entered the asset management industry, I was working for very much of CFA-oriented shops. And back in the late 1980s, there was no CAIA. So the CFA was kind of the only game in town.
Yeah.
And I'm actually a level 2 CFA candidate. I took it past level 1 in 1992 or 93 timeframe. And then we started our own asset management business, and life just got busy and got in the way. And I never went back and sat for level 2, which I do have some regrets, maybe someday. But off my career went. And I hadn't really thought about credentialing until I came to CAIA. And as you said, and rightfully so, I'm not a practitioner. At this age and stage in my career, I don't expect to be. But running an organization like CAIA, not so much in deference to the members, which is an important undertaking and certainly factored into my calculus, but I speak a lot on podcasts like this or write a lot on blogs. I started my own podcast series earlier this year. Leaving for Mumbai this evening. I'm going to be meeting with the SEBI in India, wow. and then I'm going to be on to Singapore and Hong Kong. And I think when people speak to me, they're expecting to speak to somebody that's got more than just superficial knowledge of some parts of the market. Are they expecting me to create a cogent IPS and be able to talk about every aspect of investing from a sovereign CIO standpoint? Of course not. But I felt there had to be a deeper level of understanding. And the best proof statement for me was to eat my own cooking. So I travel a lot, as I just said a moment ago, and my ability to sit down and put the time in to study was very, very difficult. But then COVID hit. And I said, well, why don't I turn lemons into lemonade? And not being on airplanes freed up a lot of my time. So So I took level one in March of 2021 and passed. And then I took the summer off because my kids were around. And then I took and passed level two in March of 2022. So I'm a very new charter holder. And I can say, not from a CEO standpoint, but from a candidate and now a member, I thought the curriculum was outstanding. And particularly in level two with the core readings, the core topics, I think there was a paper on permissioned versus permissionless blockchains, something on stable coins, something about impact investing in the private equity space. And I'm saying, wow, this is real-time stuff that helps inform me as a practitioner at a firm like CAIA, as well as a practitioner at a sovereign wealth fund and everything in between. So I really thought it was a very thoughtful curriculum. And I, as many candidates say, I really did enjoy it.
Fully agree. I think my story is kind of similar. I was studying for a CFA before CAIA, and it was just like you. I was working at an investment bank at the time, and I was everywhere. I was longer at the airplane than home, and I was studying in those long hours, etc. And CAIA was a great surprise to me. When I sat for CAIA, I already had the CFA, and I thought, well, it may be one or new things, but probably I already saw most of it in CFA, and I was so wrong because CAIA brought lots of things I didn't know and I hadn't learned even in CFA. There, for those who don't know, CAIA, in CAIA Level 2, there is one topic named Emerging Topics, and they basically select themes that are very hot in that particular moment in our industry, and you got to study all them. It's really great. And a couple other things that I learned in private equity were totally new to me. I don't remember learning that even in CFA. So yeah, it was a great thing. Content is great, deep enough. The exam is fair from what you studied. So yeah, I think it's great. From what you see, because you're everywhere, right, Bill? You are in Asia and you're everywhere. Which one of the alts do you see as the hottest at this moment? If you could group like hedge funds, private equities, commodities, and real estate, let's say out of those four, would you point someone?
They're all, in some respects, uncorrelated to each other. So I think there's a place for all of those quote unquote asset classes in your portfolio. But I put asset classes in quotes because they are no longer asset classes. And manager selection is so very important. And if you look at the median returns in private equity as an example, the correlation to public equities is probably close to 0.85, 0.9.
Very close.
But if you look at the dispersion of results from the median to the top quartile, it's separated by thousands of basis points. So you really have to be thinking about a specialist GP, a sector that's interesting to you, some geography that might be interesting and different for you as well. And that's where you're going to find alpha, in pockets of great inefficiency. But if you're going to just dial up any old GP and expect to get something better than the median results, I think you're fooling yourself. So due diligence is critically important. But even if I think about asset classes where there's value, if you do your homework in all of them, there clearly is. But I find the buyout space, perhaps in private markets, less interesting. The multiples have gotten very, very high thanks to 2022, maybe not as high as they once were. The funds are very, very big. Most of the portfolio companies are subject to a very crowded auction versus the growth space or late stage VC, where there's a lot going on. Generative AI has been very much in the news, and there's a lot of interesting optionality happening early in the value creation chain. The distress space, for maybe obvious reasons, I think could be very interesting as well. And if you can be a provider of liquidity in a market that's starting to show some breakage, you could be in an awesome spot. This denominator effect has been newsworthy and topical. And for the listeners that don't fully understand it, if I'm an asset owner, I've got target weightings in my public equity and private equity portfolio. And if private equity was kind of flat last year by most counts, whether you believe in as Cliff Asness puts it, volatility laundering or not, it did not draw down nearly as much as the public equity markets. And I think the All Country World Index might have been down 20. So if you're looking to get those back to the weights, you've got to be selling some private equity and buying more public equity. And as a result of that, we've seen a pretty busy secondary market as well. So if I think about private equity, vintage year matters a lot. And there might be some interesting entry points for getting into private equity at a very interesting price point with vintage year diversification. So I think if I sum this all up, investing is for the long term, which is one of my tag signature lines in my blog post. So I think rather than thinking about an interesting entry point at any one point in the market, it's more, can I get in at a fair price? And if my holding period, as Warren Buffett said, is kind of like forever, you're going to do quite well. And as Howard Marks, who's another person who I love to read, that you want to be buying when everybody else is panicked. Yeah. And selling when euphoria has reached a fever pitch. And I think he's probably one who's sitting around with a fair amount of dry powder, just waiting to pounce. And I think he's going to find some great opportunity going forward. Yeah, true. One of the good things to do those certifications, from my perspective, a guy that lives and works in an emerging market, one of the good things is you get to see where Brazil lies on a global picture, and you see how far we are from a big standpoint, from a relevant standpoint. Brazil is kind of developing, but it's kind of small and tiny in many aspects. We still have a long way to becoming a relevant, diversified, and huge economy. Just want to hear your thoughts if the same thing happens to candidates and certifications and these kinds of things relating to CAIA and the other certifications. Do you still see a big gap between US, Canada, Europe, and emerging markets, or do you see emerging markets coming closer and shorting the distance? Yeah, so I guess the answer depends. I think when you're trying to bring professionalism into the United States, as an example, it's a highly developed market. The first mutual fund started with Mass Financial in the 1920s. And the CFA didn't come around as a credentialing body till the 1960s. CAIA came in the early 2000s. CFP and FRM were probably somewhere in the middle. FRM is probably closer to CAIA, and CFP is probably 1970s, 1980s timeframe. So we're trying to retroactively professionalize an industry that has been around in many cases decades and maybe even centuries before any of these credentials came to bear. And the same is true in Europe. And the Dutch go back to the 1700s in some of these first commingled funds. The Buttonwood Agreement in Wall Street was in the 1800s. So I think we've got to recognize that we are never going to be what the CPA was to public accounting, which is back in the late 1800s, a bunch of accountants with the last names of Waterhouse and Coopers and Libran got together and said, let's have some standards. Yeah. So if somebody reads a set of public financial statements, if they come from Price Waterhouse versus EY, they're going to kind of look and feel the same. There's going to be standardization to disclosures and opinion letters. We are not a profession. We're an awesome industry. We are not a profession. So I always feel we've got to put the client first and foremost and put ourselves in the shoes of that client to be able to think and act like that client, to be able to give them coach and advice. And the thought that any one credential can solve for that is pure fallacy. So I think that we've got to figure out, certainly for CAIA, where we complete somebody else. And if I look at the CFA, it's kind of a bellwether, all-purpose credential, but we're much deeper on alternatives. So we can be a very good completion portfolio to a traditional analyst that's now thinking about the spectrum of uncorrelated risk premia. But maybe more germane to your question, you go into markets like India, and not nearly as developed as the US, and maybe not the same size of emerging market that you were just alluding to in your question, but massive population, awesome demographics, probably the very best demographics you're going to get anywhere in the world. And the SEBI, which is their primary regulator over there, is bringing out this alternative investment fund regulation. And they are being very, very thoughtful about, how regulation fits in and how they can work with the asset management industry. And it really seems to be a spirit of cooperation and partnership, because together, the industry and the regulator want to do right by the end investor. So you almost have the opportunity of ground zero to get a lot of these parties organized around better outcomes, versus some of these developed markets. There's lobbyists in place and everybody's pushing for their little piece of the pie, and it becomes much more challenging. So I don't think it's perfect anywhere, but I've seen examples where it works in developed countries, but examples where I see it under development in some of these emerging market countries. And what I see in a country like India looks awesome.
Yeah, we try to do this math and figure out how big is this market, or how big this market will be at some point. In Brazil, you have the CFP market going faster, because Brazil has a bunch of people that invest very tiny money and they don't have a clue where to invest it. A big chunk of our savings, national savings, is in a savings account, which in Brazil is a very, very low return. And people don't even know what a real estate, what a REIT is, or the equivalent in Brazil, or a commodity index fund, whatever. So there is a big way to go, but the CFPs, the people who advise individuals, are trying to grow faster and learn more. But I was wondering how big this market can be here for CAIAs and for CFAs, more highly skilled professionals.
And I think there the upside is enormous. And if you try to put, as analysts, we're always trying to put valuations on things, and the cash flow of CAIA or CFA is less relevant versus how big is the total addressable market. And there, if I look at it through an alts lens, by most estimates, if you look at global AUM, we could argue if it's 150 trillion or 200 trillion. And it doesn't matter as much as I think we could quickly reach agreement as to how big is the slice called alternatives. And every study or output I've seen, it's less than 20%. And it's more like 16 to 18%. Wow. And then you hear this drumbeat that I don't like the 60-40 anymore, and I want access to illiquidity premiums, complexity premiums. And I say there are now people marching to the door of alternatives, and I'm not going to try to erect an impenetrable wall, but I want a wall strong enough called education. And if you can't get over that, you should not be getting access in the first place. And I think we do the investor a disservice to be talking about an illiquidity premium, as if you can just go and get that. When we have trillions of dollars of dry powder sitting on the sidelines, I doubt most investors are getting any premium for their lack of liquidity. But if you take a step back, and I've quoted this before, Hamilton Lane did a very interesting study on the private versus the public markets. And they looked at the data on every company they could find with revenues north of $100 million. So that was the only criteria. Then they put them into two baskets, public versus private. 87% of those companies were private, 13% public. And the numbers were like over 20,000 versus maybe 4,000. So I say to the investor, forget about the illiquidity premium, complexity premium. The home of capital formation and value creation is happening in the private markets, full stop. And do you want to be in that market versus companies that are very well established? And you should look at the pace of coming to the public markets. Companies are staying private in excess of a decade versus Google. I think they were a private company for 2 years. And they had to get public because that was the only source of capital. Right now, the capital is alive and well in the private markets, and the value proposition for the end investor is that's where the value is being created. And if we're going to wait for the SPAC du jour, and thank God that game is over, or by the time it comes to IPO, so much of the value has been rinsed out, and you're acting as if you are acting as the proxy for somebody else's exit strategy. And that's a horrible place for any individual to be. If I'm responsible for my own retirement planning, which I am, we don't have defined benefit plans here anymore in the States. So I think that we've got to make sure that we are explaining the value proposition correctly. I don't think it's that complicated. And I think that's a much better way to describe it versus this mysterious illiquidity premium. It's just nonsense in my mind.
And education is the key, right? Because, people don't go to private investments. It's probably not because they don't like it, but because they don't know it or don't know how to access it.
Yeah. And I think that what CAIA can bring to the table is a set of skills and tools around due diligence and manager selection, and give the analyst the wherewithal, the knowledge, the courage to ask all of the right questions. And I mentioned dispersion of performance results earlier, Raphael, and if you pick the wrong active manager in the public equity markets, it could cost you 50, 75 basis points. Annually, that's a lot. But if you pick the wrong GP, your money is locked up for 5 to 7 years or maybe longer, and it could be costing you 1,000 or 2,000 basis points annually. So, so you really set yourself up for an absolute disaster if you don't do your homework.
No, exactly. Bill, let me I'll make you a question. It's a very easy question, and I'm sure anyone can answer it. But you, from your position and from the view you have, I think you were on the top list to answering this question. And the question is, how do you see the future of alts? And it's a broad question, of course, but I'm thinking of several things here. AI playing a role in portfolio management, and computers making the decisions and allocating money for us. How do you see alts taking down this road, and how do you see this market in, say, 5 years?
So a couple of things. One, this whole conversation around generative AI and people mostly talking about ChatGPT. This has only been a 6-month phenomenon, but the subscribers to ChatGPT went from 0 to 100 million faster than TikTok, and people thought TikTok happened quickly. I think that with ChatGPT, it happened in a matter of weeks or maybe something less than 2 months. So the acceleration was enormous and a lot of eyeballs on it. And I just saw in the news last week that JP Morgan is now experimenting with something called Index GPT that's going to pick stocks, which prompted me to write a blog post just a couple of weeks ago. And it's fashioned off an old statement, as some of your younger listeners may not remember the phrase, "Where are the customers' yachts?" And it was uttered by this fellow, William Travers, in the late 1800s, when he saw all these yachts out in the beautiful water and found out they were owned by all the brokers, and none of the clients owned any of these yachts. So I took a play in words saying, where are the clients' bots? And are these bots helping improve outcomes in the investor, or fattening the profit margins of the big banks and asset managers? So I went to ChatGPT and I asked it a very simple question. Can you be a fiduciary? And it was brutally honest. The answer was no, I cannot be. It requires certain traits around transparency and trust and loyalty. And I'm a machine. I cannot do that. So I think we have to recognize that the machine can process a lot of data, and they work with these large language models, and they don't get divorces. They don't get drunk at night. So they're always on. And you don't have to worry about that. But their processing skills should not be taken in isolation. We should recognize how that can augment the human analyst. And I think if we could harness that power, it could be awesome. So I think we're in the early stages, but I think there we are going to see that as a bit of a game changer in our industry. But maybe the only other thing I'll emphasize for the moment is the whole concept of distributed ledger technology and digital assets. And here I'm not directly talking about Bitcoin or Ethereum. I'm not a Bitcoin or Ethereum hater. I don't own any myself because I really don't understand it. It's very, very volatile. How it fits into my portfolio, I'm less sure about. But I will say the distributed ledger interests me a lot. And if you think about, I mentioned the Buttonwood Tree, which is basically the beginning of the settlement and specialist network on Wall Street many, many centuries ago. That was really an act of collusion. It was 10, 12, 15 white men that got together and said, let's just trade with each other and let's set the same price and we're going to control the marketplace. And off they went. And I don't know what it was back then, T plus something. It was probably 5, 6, 7, 10 days. And ownership was demonstrated by somebody handing you a piece of paper with a number on it and saying, if you come back in 7 days, I'll give you your money back based on the current market price. And that was the creations of a liquid market for public equities, which back then was an illiquid market. If I own 100 shares of IBM or Walt Disney, that's not a liquid thing, but we created a mechanism to do it. So if I think about accessing the private markets, and I don't have a Buttonwood Tree, I don't have a stack of newspaper or a printing press to create stock certificates, but I have distributed ledger, immutable, transparent, open to all sets of eyeballs. All things being equal, I think that's a much better tool than these 20 guys under the Buttonwood Tree. So I look at KKR and Hamilton Lane, both recently in the last 6 months to a year, came out with a garden variety Cayman-based fund. And all of these funds have a Cayman-based fund, and they have feeder funds on other platforms. Cayman because it's tax-neutral jurisdiction. In both cases, they created a feeder fund in the blockchain. Early days, and it's a private fund. But what I like so much about this, if I compare this to BREIT, is that BREIT promised liquidity on a delayed basis, 5% quarterly, 20% annual through the interval fund structure. But when the redemptions line up, the fund gets gated because they end up selling off all the illiquid pieces. If a product is on the blockchain, it's going to have to be permissioned back to the CAIA paper I mentioned before. So there's going to have to be a referee in there. But if you want in and I want out, somebody's going to have to help us with price discovery. And if we don't like the bid or the ask or the spread in between, transaction doesn't happen. But the fund itself does not have to create any liquidity, regardless of what you and I want to do. So again, early stages, but if I look at the power of distributed ledger, I think it's mostly been used around Bitcoin and Ethereum, and then FTX comes and goes. And I think it sets back maybe the reputation for some of these very powerful tools. But you look at the internet, how many false starts the internet had. Netscape, when I was early in my career in the 1990s or mid-1990s, they had 90% of the search activity. Some of your young listeners say Netscape, never heard of them. It's Google. They had it all and they lost it. So I think you're always going to have rinses outs of these early players and early actors. But after the rinse outs, the value proposition becomes clear. So I think an important trend to pay a lot of attention to going forward is if we have to figure out democratization, giving the average investor greater access, blockchain is sitting right there for the taking in terms of the solution. And we haven't sorted it out yet, but I think there's going to be something very powerful there.
Nice. That's very interesting. And that's why CAIA is looking ahead and had this idea to start the FDP Institute, right? For those who don't know, FDP, well, FDP, Bill, I'm not sure if you know it, but it's a very, very bad word in Portuguese. So they told you, right? Yeah. So for those who don't know, CAIA Association created this institute, which is kind of a sister to the CAIA Association. It's named FDP Institute, and it created its own certification named FDP Charter, which is based on data science and all this new technologies applied to finance. So just want to hear from you, how do you see FDP and the data science knowledge fitting into this world of DLTs, cryptos, and we have a bunch of other ones, but how do you see it fit?
Yeah, so the origins of that were right before COVID. So the momentum was very, very strong. COVID hit, the exam centers got shut down, so it sort of set the pace of play back a little bit. But the concept and the idea, as you just laid out, is still very much alive and well. And the origins of FDP were that we talked to a lot of big asset managers and allocators around the world. We're back close to doing 300 live events every year around the world too. And we were talking internally about sort of some of the common themes. And we were seeing NLP, ML, AI, in this case, not alternative investments, artificial intelligence. Mm-hmm. But then more importantly, we were talking to some of these large asset managers and talking about where they're sourcing their talent from. And no longer was the competition in the B schools. It was coming out of Apple, Microsoft, NASA. And they were bringing in full-on data scientists into their investment process and having them work with all this alt data. And we said, well, how is the CAIA or the CFA, who's expert maybe at Excel, going to communicate with a data scientist who's programming in Python or R? So we're not trying to turn the analyst into a data scientist. We're trying to turn them into a translator. Let them understand how to work with data sets. Let them understand maybe some of the working knowledge of Python or R, although ChatGPT may make the need for programming moot, we'll see. But at least give them the courage and wherewithal to work side by side to create a better investment process. And that's what we set out to do. And then coupled with that, the ethics in this space are very, very different than you would see in a CFA or a CAIA charter program. In that data privacy, we do not have a national definition of data privacy here in the US. So if I'm sucking in this all data from all these different sources, how do I know I have the freedom and the ability to do that? If somebody is scraping my data from LinkedIn or from Instagram or from Twitter and selling to somebody else who's selling to somebody else, it may not be anonymized. It may not have my permission. It may not be for sale. If I'm a CCO, I think that job has gotten very, very difficult because we're well ahead of not only a definition of privacy, we're well ahead of the regulators as well. And typical, and we saw this in the news today with Coinbase, when the regulators want to slow something down, they think about regulation, codification through enforcement. And I think we're going through a phase right now where I think we're going to see more and more of that in the digital asset space and maybe also in the use of this alt data. So I think we as professionals are early. I think there's a tremendous opportunity there, but we've got to treat this data very, very carefully. And when in doubt, don't use it.
Excellent. Well, Bill, can't thank you enough for your time, your advice, and all the things we discussed. I just want to wrap up this talk by doing one thing that I always try to do to our students. As you know, some of them, well, most of them are freshmen. They're people recently graduated. And I always try to tell them, if I was, my elder version, why would I tell them? If I met myself at 2021, what would I say? So I would like to hear from you. If you were to meet young Bill at early 20s, he's still interested in CPA, he's still interested in the financial market, what would you tell him? Just keep an eye on this and that, behaviors, values, philosophies. What would you say?
So I've got 5 kids of my own, so I try to bring this forward every single day. They sometimes listen to me, they sometimes don't. My youngest just graduated high school last week, so he's going to be the only one who's going to be in college. The other 4 are out of college now, but I try to give them advice that's practical and that they can use. And if you think about back in the day, there was a movie called The Graduate. And this young fellow's graduate is Dustin Hoffman was the actor, and he goes out to this older guy at the swimming pool, and he says, "I'm going to say one word to you: plastics." And Dustin Hoffman's there. I don't know what the hell you're talking about. So I think if I use my own version of plastics, it would not resonate well. So I try to break it down, just as I said earlier, describing the private markets. Curiosity. I think that's maybe the headline and the news story. I've been incessantly curious in the entirety of my career in terms of what I read, what I'm interested in. If somebody explains something to me and I don't understand, I ask them to explain it again. I can't tell you how many conferences I go to, and I go to a lot. And I used to be the youngest person in the room. Now I'm the oldest. The youngest or oldest Nobody asked that first question. So it's an awesome opportunity, not only to show your curiosity, but to establish your brand. And most of these conferences will ask you to cite your name and the company you work for. So I think that these are great ways to stay curious. And I would say maybe tied to that, I reject nothing but question everything. So if I mentioned earlier Bitcoin and Ethereum, I don't understand it, but I'm going to keep asking questions on it until I'm informed enough to reject it or informed enough to invest in it. And especially if you look at the pace of change in our industry right now, it's happening faster than I've ever seen it happen. So I think if you're mid or late career, it's incumbent that you ask questions and probably come back, Raphael, and see you and find out, how I can fill in some of these pockets of where I have gaps. But I think I think I've seen as people get older and further on in their career, they're sometimes embarrassed to ask questions because it's going to show they're ignorant or uninformed about something. I would reject that notion. There's something for every single one of us to learn. And that's why I love my job. I learn something new every single day. If I put in the knowledge that I have versus all the knowledge in the world, the knowledge I have, you could probably fit in a thimble. And that's why the world is our oyster. There's just so much more that we can learn. And especially the areas that are interesting to you and where you want to be a little bit more of a domain expert, you want to go as deeply as you possibly can there. So stay curious.
Nice. There's one other nice thing that happened to you, well, at least hearing your story, I get that. The way you can pivot your life and your career several times. So there isn't really long term, it's just a fiction. What exists in reality is just a bunch of short terms connected together, and you don't see much longer than next week or probably next month. So your curiosity added to this ability to change limitless futures for yourself can turn out very well too.
Yeah, I agree. And I've been fortunate in that it's opened up a lot of interesting doors for me. And I sit on boards of directors. I chair audit committees. So it allows me greater outlets. And I think that's another important aspect of this too, is that we always got to be thinking about, where you want to go next. And that silly interview question, where you want to be in 5 years, put that aside. But I think everybody's got to be thinking career-wise in increments of maybe the next 5 to 10 years about where they are and where they're trying to get to. And as I said earlier, nothing's a straight line, but I can't tell you how many people have come to me in their late 50s and maybe early 60s and saying, I want to sit on a board, or I want to go and have a job like yours at the CAIA Association because it's time to sort of give back. You have to plan a little bit for these things. And planning I didn't sit back 10 years ago and said, hey, I want to be the CEO of CAIA, but always thinking about, well, once I leave this industry, what do I want to do? And being an accountant by past experience, it allowed me an entry point to audit committees, getting involved in the board of directors, getting involved in liquid alts, which led me to CAIA. So I think you've got to figure out, especially as you're getting later in your career, unless you've got a very good golf game and unlimited money to go and travel. I think even if you have that, you're going to find yourself pretty bored, and you want to find professional outlets, and you got to be thinking about that in advance of your 55th or 60th birthday.
Great. So, well, Bill, can't thank you enough for your time, for the messages, the lessons, and for all of you who are watching us. If you have any further questions to Bill, make sure you type them down. We'll try to get to Bill and reply them back. We encourage you to keep in touch with us, to engage in all this education and knowledge path. The CAIA is certainly a great asset. Lots of knowledge, lots of practical things. And Bill, thanks again for being with us. And we'll be in touch. I hope it will be a very, very relevant market to CAIA and to executive education.
Obrigado.
De nada. Thanks a lot. Bye.